The interest rate on a home loan is the amount a lender charges you to borrow money, and an interest rate affects your monthly loan payment. Take a look at these general examples. If you have a home loan for $400,000 at a 4% interest rate, your monthly principal and interest payment would be $1,910. At 5%, the payment rises to $2,147, and at 6%, it goes up to $2,398 a month. Because the interest rate affects your monthly loan payment, it in turn affects your debt-to-income ratio. A debt-to-income ratio is just a fancy term to explain what percentage of your income is going towards your debt each month. It's one of the things lenders and mortgage providers use to determine how risky it is to lend money to you. Note that expenses such as groceries, utilities, and gas generally don't factor into your DTI ratio. Interest rates will affect your debt-to-income ratio because as your interest rate increases, so does your payment, resulting in a higher debt-to-income ratio. As a general guideline, 50% is the highest DTI ratio a borrower can have and still get approved for a mortgage. Ideally, lenders prefer a debt-to-income ratio lower than 36%, with no more than 28% of that debt going towards servicing a mortgage or rent payment. The DTI ratios vary from lender to lender. Take a look at this general example so you can calculate your DTI. First, total up all of your monthly debts such as your estimated mortgage payment, property tax and property insurance, credit card debt, car payment, student loans. Then take the total monthly debt, divide it by your total gross income, which is the monthly income before taxes, in order to get your monthly debt-to-income ratio. If you are over 50% DTI ratio, then it's very likely you will need to pay down some of your debt to qualify for the loan or borrow less money for the house so your mortgage payment is less expensive. So as you can see, a higher interest rate may increase your monthly debt and affects how much you can borrow. An interest rate also determines how much extra money you will pay in interest over the life of the loan to the bank. Using the same example of a $400,000 loan at 4% interest rate, you will pay over $287,000 extra to the bank over the 30 years. At 5%, you'll pay an additional $373,000, and at 6% interest rate, you'll be paying an extra $463,000 to the lender beyond your original $400,000 loan. This means at 6% interest rate, you'll pay a total of $863,000 over the 30-year loan. As you can see, interest rates matter. They affect how much you will pay and how much you can afford. Before jumping into a loan, give us a call to see if you are getting the best rate possible. If you're ready to buy, sell, or invest, Pinion Properties is your real estate one-stop shop.